All right, folks, today we're going to talk about a popular product called a home equity line of credit. A home equity line of credit allows you to access the difference between the value of your home and what you actually owe on the first mortgage loan. So they tie a line of credit to that difference. So let's say you owe $500,000 on a home, it's worth $1 million. You have $500,000 in equity in that property. Now, home equity lines of credit get a lot of bad raps, and I want to address some of those also here today. So a home equity line of credit is actually a great tool. Number one reason is it allows you to pull money out of your home without paying capital gains taxes because it's a loan. You're not actually selling the property or actually liquidating anything. So you don't create a taxable situation. Yes, there's going to be a loan payment involved. And one of the negative things that a lot of people say is, well, Sean, it's an adjustable rate mortgage loan, isn't it? Of course, absolutely. But like my good friend Sean Herrero just said, a home equity line of credit, this may never be a better time to pull out a home equity line of credit because as the Fed begins lowering interest rates, your equity line of credit will go down. Yes, it's an adjustable rate loan, and the people who got one several years ago are experiencing those slightly higher rates and higher payments right now. But when the Fed starts lowering the Fed funds rate, those payments will go down. So, for example, what I did was I took a home equity line of credit and we just recently put in our pool. We got our hot tub, we got our fire pit. And what I did was I pulled that equity out and I was able to pay for all of this in essence cash. I was able to write checks to the contractors as this job was being done. As the balance goes up, the payment goes up. But as the Fed begins lowering the rates, I'm going to see my payment go down. This is a great way to access cheap money also because they typically will put these on 15 or 20-year loans so you don't have a big high note like a 5-year note or a credit card, things like that. And even in some cases, you can deduct the interest from the home equity line of credit from your taxes. Now, ask your CPA on what your options are. It involves whether you have a business or whether, like me, you have a farm, or if you took it out at purchase, or maybe you got the home equity line of credit after you've already moved in the home and lived in the home for a while. But here's the other thing. Yes, you'll be paying interest. However, I do know that this outdoor space that I created on my house definitely made the value go up. So I'm going to pay more in interest over the next several years, but my value of my home is exponentially going to go up. And guess what? Instead of paying cash for my property, my upgrades here on this property, I went ahead and kept the money invested. And in the market, I got 18.9% last year, which was double, almost triple what the actual interest rate is on my home equity line of credit. If you have questions about this, or you've used a home equity line of credit, drop me some comments below and give me a like. Thanks for the follow, and please share this.